Well, a very special guest, Naren of ICICI Prudential AMC joins us to try and to help us and help our viewers understand and dissect the scenario. Locally, the mood shortly after the finance minister's press conference has changed. Have the announcements done enough to kickstart the economy? What about global cues? And what about the on-ground reality about slowdown and what is happening to consumer demand? So let's connect the dots here with none other than Naren. Naren, good morning. Fantastic to have you back on ET Now. Thank you for joining us. What do you make of Friday's press conference, the announcements which have come from the finance minister? Do you think they are enough to mend the economy and fix the slowdown?
See, clearly these are steps in the right direction, and the way it has been done, for example, by increasing depreciation temporarily on auto and giving a lot of capital to the public sector banks, these kind of steps I think are extremely positive, because that is the kind of steps which are sustainable. You can cut rates and you can cut GST rates significantly, but then you can have the repeat of 2009 to 13 when a fiscal stimulus was given and then it could not be withdrawn, and that led to a big expansion of current account and created fiscal deficit increase. So I think the steps are in the right direction, and one can't ignore the fact that globally if the US Fed chair says, I don't know what to do about trade wars, what would an emerging market country like India have to say? Because even the US Fed is saying that it is difficult to know how to handle trade wars. And those kind of factors are also somewhere at the back of what is happening in the markets, and that should also not be forgotten when we look at domestically. I believe that if there was no trade war increase on Friday, the markets would have opened up maybe 3% higher today. But that is the kind of scenario we are in. We are in a very globally volatile world where every day we are looking for tweets at all times of Indian standard time. And that is the situation we are in at this point of time.
We've suffered largely because of two factors. One, global uncertainty, and B, a deterioration in local fundamentals largely on account of tax front and unevenness of tax. Do you think that local disadvantage which has hit us and which has caused massive underperformance in the month of July and August, and perhaps capitulation in mid and small cap stocks, that could recover? I mean, now we are likely to move in line with global cues.
Clearly, my guru Howard Marks says that there is something called a cycle. When the cycle is at the top, let's say small and mid cap valuations in 2017, no one complains because the valuations are excessive. If you look at the real estate sector in 2012-13, it had become unaffordable, and maybe even today it is. So the challenge is, when you're at the top of the cycle, frankly, you have to expect corrections, and cycles are something which will keep happening. So I think one of the mistakes that most people don't believe in is that every cycle which goes up has to keep on going up. So like the small and mid cap cycle, the real estate cycle, today if you look at mega caps, quality stocks, they are not cheap at this point of time, but no one will want to recognize that cycles will play in every asset class, in every type of equity, etc. So I think that is one challenge which exists. And clearly, if you look at it, there has to be people misallocate money in small caps in 2017. There is a negative that is likely to come, and that negative benefit is what we are seeing at this point of time. What exactly happened, if you look at it, is NBFCs gave a lot of opportunity for the weaker borrowers to borrow. And those weaker borrowers actually increased consumption temporarily, and with the slowdown of money to the NBFCs, this category of consumption has certainly slowed down. I think that is a challenge. What worries us at this point of time is the fact that gold loans are doing extremely well. And if you look at the situation, it looks like people are saying that today I'm not able to get money without security in other forms of borrowing, but I'm willing to borrow through gold loans. And the fact that gold loan borrowing is shooting up is actually a source of worry the way we look at it from an economy construct. So what is required is consumption to slow down. I think interest rates to drop drastically. Then the balance sheet repair happens in various parts of the economy, and then you have a structural bull run based on low interest rates, low prices of land, low prices of labor, and that combination always works very well. But if you want this to happen, it is never very easy. But from a investment angle, it becomes very easy. You follow asset allocation strategies because it results in a situation where debt gives you return first and then equity. The mutual fund industry has done very good work on SIPs, and the SIPs in categories like small and mid cap are great investment opportunities at this point of time. We've been continuously recommending investors to invest in debt. Debt is a great short-term asset class over the next 1-2 years. So we've got a wide variety of products, but cycles will remain cycles. You can't always have a cycle which just keeps going up. That is something people want cycles to just keep going up, but you will have cycles both in all asset markets. You will have cycles.
So Naren, my immediate follow-up question would be that if I work with the assumption that global uncertainty is here to stay, central bankers are worried about global growth and economic slowdown that will create pressure on emerging markets. If that is your underlying thought, then can I say that the risk to large caps right now is far higher than risk to mid and small cap stocks? Because foreigners, if they sell, they frankly don't own too many small and mid caps, they own large caps and mega caps.
While from a valuation angle, mega caps are extremely overvalued, the problem in India is there isn't enough big long-term money which gets invested in small caps. All the long-term money today is being invested today in Sensex, according to what newspaper I read last week. So what happens is that, somewhere the fact that the longest long-term money today that can be invested is EPFO, and that money is going into Sensex ETF, that will actually support the mega caps which are costly. And on the other hand, there are small caps and mid caps which are actually extremely cheap, which make for very good long-term investments, particularly through consistent investing, which long-term investors can do. But the money is today going only into mega caps. So clearly the fact that there is long-term money inflow into the mega caps is actually protecting the mega caps, while the mega caps are costly and the small caps and mid caps are cheap. The near-term outlook is not very clear to me. I think it is clear to me when I look at with a 5-year SIP kind of construct, small and mid caps turn out to be extremely attractive at this point of time. But the near term is always dependent on who's the marginal buyer and who's the marginal seller. There is a potential marginal seller in the form of FIIs, but similarly, there are enough marginal buyers in mega caps among locals. So that's a positive if you ask me for the mega caps, and a negative is that in small and mid caps there are very, very few buyers at this point of time, barring mutual funds, and that's how it is totally dependent on how mutual fund flows happens in small and mid cap funds over the next 2 years. Having said that, the 5-year outlook, if I look at it, clearly is superior for small caps. Because there the valuations are attractive and there is enough fear in the valuations at this point of time.
Naren, you are a practitioner of market behavior and you connect the dots of market behavior, pricing and underlying fundamentals. Where do you think the market fundamentals are ahead of themselves? And where do you think market sentiment is ahead of themselves? Just for the benefit of a viewer, what I'm trying to ask Naren here is that where Naren feels that market right now are pricing in too much of optimism and too much of pessimism. Naren.
If you look at where maximum pessimism is priced, it is clearly in credit. If you look at it, every one of the debt mutual funds of our company have done well over the last 1 year, and despite lot of noises and lot of downgrades. So the reality is that in India, a single A credit paper still gives you 10.5%, which makes it an extremely attractive asset class. But because sentiment is so negative, there is only outflow in that asset class, and it is the most attractive asset class because it meets all my requirements, valuations being attractive and sentiment being very negative because you have huge outflow. On the other hand, when I look at mega caps at this point of time, I see valuations being clearly above one standard deviation from normal, and you have huge flows into that category. So I think that is where markets are costly, and where markets are cheap is in clearly in credit, in small caps, then mid caps, then entire value stocks including PSUs. And those are the areas where I would say sentiment is extremely negative, and therefore valuations are extremely attractive at this point of time for long-term investors.
Naren, now low interest rates are here to stay, not globally but locally also. If that is the case, does it make sense to buy utilities, buy rate sensitives? As a broader theory, if I look at your portfolio, you have utilities in your portfolio, the likes of NTPC, Power Finance. So what is the underlying thought? Because these two stocks are a very large part of your core now.
Clearly, in a decreasing interest rate environment where the economic growth is not very, very high, we look globally and found who are the people who can actually deliver very good returns. Because this is what happened in the developed world post 2008. And we found that utilities did very, very well, along with all kinds of dividend yield stocks. So we think in a period where the economy is not growing very fast, and we think that utilities and dividend yield stocks are two very, very interesting areas. When people look at rate sensitives, what happens is that end of the day, you've had a situation where most of the retail financiers have done very, very well over the last 10 years. And there has been no retail credit cycle for the last 10 years. And our worry comes from the fact that every other category connected to consumption has slowed down, but retail credit hasn't slowed down. So, we are people who believe in cycles. So we think that retail credit should slow down, at least in terms of growth. So we're waiting for that growth slowdown at some point of time to actually buy a structurally good sector. So that's how we look at it. And I think the interesting thing at this point of time is there are many stocks with dividend yields above 5%. And those stocks people are not willing to look at, whereas people are happy to look at quality stocks which are trading at 70 times trailing. And if a stock is trading at 70 times trailing, there is a lot of inbuilt growth assumptions into that 70 times trailing. So that's how we see a two-sided market. One is of a set of quality stocks and mega cap stocks which are trading at high valuations, and everything else which is trading as though we are in a recession. So I think clearly as a contrarian value-oriented investor, I think clearly I believe in the cheaper basket at this point of time along with debt, because I think both these baskets look very attractive at this point of time.
FPI tax was introduced in the budget. Foreign institutional investors, they started yelling, they started screaming, they started selling, they started complaining. 15,000, 17,000 crores of net outflows is what we've seen in the month of July and August. Now to imagine that whatever has gone out will come back, I think it will be too naive. I mean, was FPI tax the only reason why FIs were selling?
I think you should look at what has happened to China market in the last 2 months. You should look at what has happened to Korean market in the last 2 months. Many of these markets have also come down. In fact, there was one day where Dow came 800 points. Again, last Friday it came down 600 points. So I think globally the cycle was like, the market valuations were not cheap in US, and in other parts of the world, the entire trade war has spooked investors. So, but we are in a very interesting world. If $13 trillion of debt globally is in negative interest rates, and India is possibly the only country in the world which offers you very good interest rates, this is an opportunity, because a lot of income generating assets today are very, very interesting for global investors, which is one of the reasons, for example, many of the Canadian pension funds have invested in India, is because you have now a structural zero interest rate environment in most of the developed world. And therefore, India offers many of these income generating assets, so they can actually look at for long-term investment. So I think India has a big opportunity there. If we are able to present a very interesting opportunity for accelerating growth from selling income earning assets at low interest rates, I think that would be a very big positive. I think the government is also thinking about it, and I think many of those areas is likely to do well. But on the whole, I would say we are in a very confused global environment. But having said that, you have to remember that the best time to invest in equity is not when everything is good. Actually, the best time to invest in equity is when everything is bad and valuation is cheap. Today, valuations are cheap in most of the market, and so except a few areas, and therefore this is a good time to actually look at investing compared to 2017 when everything was looking good but valuations were very costly. I think, as every global guru says, equity is an asset class you invest when things are not good, not when things are great. And that's why today we are much more sanguine on equities than we would have been 2 years back. And in small and mid caps in particular, 2 years back valuations were excessive, now they are cheap. So everything points to good long-term returns, but one needs patience. And because no one knows how cycles operate, and if you're not patient, a long-term investor may still not make money after investing today. But this is a much better time to invest, and I believe that I think there is an interesting opportunity at this point of time, because I have historically seen that whenever there are big global problems, that is a good time to invest in Indian equity. And today there is enough global problems, and which is the reason it's good for long-term investment at this point of time.
Naren, the disruption in autos. One, there is EV. On the other side, there is a massive slowdown. Do you think the current confusion or decline in autos is a great opportunity, or more like a godsend opportunity for long-term investors? Because Naren, these are good companies, they don't have leverage problem, they generate a lot of cash. Some of them have moat around them because competition is not easy, brands will not get created. Are you using your contra style to buy into autos right now, given there is only bearish talk on the street about autos?
Clearly, there are interesting opportunities, but I think if you look at some of the other sectors, they have gone through a period of 12 years no return. Would I prefer a sector with 12 years no return?
All right.